What is a dividend, and why do some investors love them? A dividend is a portion of a company's earnings that gets paid directly to shareholders, like a financial thank you for owning the stock. It's the company's way of sharing its success with you. But not every company pays dividends. Fast-growing tech firms often reinvest profits to fuel expansion. On the other hand, well-established giants like Coca-Cola, Johnson & Johnson, and Procter & Gamble are known for consistently rewarding their shareholders with regular dividend payments, year after year. How and when are the dividends paid? When collecting dividends, timing is everything. Owning the stock at the right time determines whether you get paid or miss out completely. Here are the 3 critical dates you need to understand when talking about dividends. Declaration date. This is the day the company officially announces how much the dividend will be. The record date. Who gets paid? The payment date. When you get paid. Ex-dividend date. This is the most important date for you as an investor. If you want to receive the upcoming dividend, you must own the stock before the ex-dividend date. If you buy the stock on or after the ex-dividend date, you've missed the payout, even if you hold it on the payment date. Because of the way the stock market settles trades, you need to buy at least 1 day before the ex-dividend date to be eligible. For example, if the ex-dividend date is July 14th, you must buy the stock by July 13th to receive the dividend. Payment date. This is when the dividend is actually deposited into your account, either as cash or automatically reinvested, depending on your broker settings. This date is usually a few weeks after the record and ex-dividend dates. It's when the company sends out the money to all eligible shareholders. Let's explore the key concepts related to dividends. The dividend yield tells you how much cash income you're getting from a stock relative to its price, similar to the interest rate on your investment. Let's say Company A pays an annual dividend of $3 per share, and the stock is trading at $75. So it has a 4% yield. This means for every $100 you invest, you're earning $4 annually just from dividends, not including any stock price appreciation. Why it matters? It's great for comparing income-producing stocks. A higher yield might look attractive, but can sometimes be a red flag. Compare it to alternatives. If your savings account pays 1%, but this stock pays 4%, that's a big difference in cash flow. The payout ratio tells you how much of a company's earnings are being paid out as dividends. If a company earns $5 per share and pays a $2 dividend, this means it has a payout ratio of 40%. Why it matters? A low to moderate ratio, 30 to 60%, is usually sustainable. A very high payout ratio, 80% or more, means the company is using most of its profit to pay dividends, leaving little room for reinvestment or for handling downturns. In some cases, companies may borrow money to maintain a dividend, a warning sign for investors. There's a special case worth mentioning, and that's REITs. Unlike regular companies, REITs are legally required to pay out at least 90% of their taxable income as dividends to keep their tax advantage status. By passing most of their earnings to investors, REITs act more like pass-through entities. It's a win-win. Investors get regular income, and the REIT avoids double taxation. Failure to meet this rule can result in losing REIT status. Some companies don't just pay dividends. They increase them consistently year after year. Let's say you buy Johnson & Johnson and it pays $3.50 per share this year. If they raise it 6% every year, in 5 years, you'd be earning about $4.70 per share, even if the stock price stays flat. Why it matters? Keeps up with inflation, preserving your purchasing power. Signals financial strength. Consistent raises show the company has strong, reliable cash flow. Many investors prefer dividend growth stocks over high-yield stocks with stagnant or risky payouts. Instead of taking dividend payments as cash, many investors automatically reinvest them to buy more shares, using DRIPs, dividend reinvestment plans. Let's say you own 100 shares of a stock that pays $1 per share annually, $100 in dividends. Instead of cashing out, you reinvest and buy one more share, assuming $100 per share price. Next year, you have 101 shares, and your dividend grows without adding more money. Let's talk now about two elite groups, Dividend Aristocrats and Dividend Kings. Dividend Aristocrats are companies in the S&P 500 that have increased their dividend every single year for at least 25 consecutive years. Requirements to be an aristocrat: must be in the S&P 500, must have a 25-plus year streak of dividend increases, must meet certain market cap and liquidity thresholds. For example, Coca-Cola, PepsiCo, McDonald's, Procter & Gamble. Dividend aristocrats tend to be large, established companies with strong business models, financially disciplined. They prioritize shareholder returns, resilient. They've continued growing payouts through inflation, wars, and market crashes. Dividend kings are the highest tier, companies that have raised their dividends for 50 consecutive years or more, regardless of market conditions or index inclusion. These companies aren't required to be in the S&P 500. They just need that 50-year track record. Some dividend kings are Johnson & Johnson, 3M, Lowe's, Colgate-Palmolive. Both aristocrats and kings are often seen as defensive plays. They tend to hold up better during market downturns. Income generators, ideal for retirees or long-term investors focused on cash flow. Trustworthy, with management teams that prioritize shareholder value. Here's the kicker. Many of these companies kept raising dividends during the dot-com bubble, the Great Recession, the COVID crash. That's not luck, that's long-term strength. For many investors, these companies become core holdings. Here's why. They provide income stability regardless of market conditions. The dividend increases help fight inflation over time. They often come with lower volatility and higher investor confidence. Dividends aren't just a nice bonus. They're a powerful part of long-term investing. Whether it's the steady income, the potential for growth, or the discipline of dividend-paying companies, dividends can give your portfolio stability and cash flow. If you found this video helpful, press the like button and subscribe. Thanks for watching.